Hello everyone and welcome to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters across the franchised and independent dealer sectors.
Hello and welcome to this Motor Trade Radio weekday special. We're delighted to welcome back Chris Plumb, Head of Current Car Valuations at CAP HPI, joining us for this exclusive roundup of how trade values performed in July. Now, by way of a quick recap, last month CAP HPI reported a small dip of just 0.6% for June, very much in line with the average for the month, and was forecasting a similar dip for July. So we're about to find out if that welcome resilience that we've seen in the year to date continued through July. We'll also take a closer look at some of the key trends in this month's CAP HPI editorial. In the second half, we'll have a chat about current car valuations and the challenges of setting RVs for the plethora of newly launched brands that we're seeing, plus the likely impact of the electric car grant. So, plenty to chat about. Welcome back to the pod, Chris.
Thanks, Curtis. Hi, everyone. Hi, Phil.
Hi, Chris. Good to have you on. I know you've stepped in today. It's nice to get the mix between you and Jeremy. I think he's been a bit unwell today by all accounts. So a little bit more in your direction. But it's great to have you back on, Chris.
No, thanks for inviting us back on. It's a busy day for us because it's publication day. So the movements that we're going to run through certainly hot off the press.
Yeah, we won't get into filling shoes and things like that and who's best. It's equal between you and Jeremy.
One team. One scenario. You know that.
I mean, Kurt's just given the overview of the drop from June into July there. Do you want to talk us through initially the headline figure for that 3-year 60 for July going into the month of August, and how does it start? How does that compare with previous movements for that same period?
Yeah, no problem. So July recorded a 0.5% to 0.5% movement down, which equates to circa £95-100 at that 3-year 60 benchmark profile. This represents the joint third smallest or most positive decline when we look at those historical movements from July to August since we introduced CAP Live back in 2012. But of course, that's when we exclude the usual CAP or the usual COVID-affected years of 2020 and 2021. The only years that sort of beat this year's movement was 2022, which was a small drop of 0.2%. And then last year, it was a small drop of 0.4%, with this year being tied to 2017, with being the third strongest month that we've reported. So that resilience in the market has continued.
And how does that now look in terms of the year-to-date position? It seems like we're getting a softer depreciation, particularly in sort of Q2 as we enter Q3.
Yeah, we're kind of seeing, it's been really encouraging actually when you look at where we've been performing versus previous years. So when we look at each month's movement in isolation, if we exclude March, when our monthly product movements aligned with the average seasonal expectations, every month this year, including now August, has performed better than those seasonal norms. Particularly when you look at the summer months, have performed more favourable. With August, let's say that three-year-old point, a movement of 0.5%, aligned with actually being 0.5% stronger than the seasonal average of -1%. And this is the second consecutive month we've seen this level of outperformance. The consistent trend suggests, again, underlying market resilience driven by that shortage of desirable stock as supply and demand currently appear particularly well balanced.
And Chris, we'll look at fuel trends in a moment, but before we do, were there any notable price movements by age points over the course of the month?
Yeah, so values did drop across all of the age points. So when we look at the 1 year point, the average movement down was 0.7%. which is about circa £200, while 5-year-old vehicles saw a decrease of 0.6%, or just £65, and at 10 years old, vehicles experienced a larger decline of minus 1.4%, but in monetary terms, that only sort of came out to £50. And some of the bigger movements we're seeing in percentage terms across those older age points are really similar to what's seen in previous months, mainly driven by higher mileage, lower quality vehicles in the market.
And how did the various vehicle sectors perform? Because I did notice it was a particularly good month for convertibles and supercars.
Yeah, so convertibles and supercars were the only vehicles to exhibit positive average movements this month, both recording an increase of 0.2%, while sports remained level. Interestingly, coupe cabs recorded their first negative adjustment of this year, declining by 1%. However, that's quite a small sector now. I think it's only driven by one or two vehicles within that. Convertible, even though it was a positive movement at 0.2%, has the performance has been reducing over the last couple of months, kind of more aligning with some of those seasonal movements as we sort of, I don't want to say head out of the summer, I don't want to wish the life away.
Yeah.
But as we know that the performance starts to sort of tail off as we get to the end of the summer months and into autumn. So it certainly seems like that's happening. But when we look across some of the mainstream sectors, sort of city car recorded the largest movement, again at the 3-year point, down just 1%, though again in monetary terms it equates to about £60. SUVs remains the most dominant in terms of the research data that we've received in July into August. So about 40% of vehicles aged up to 20% now, up to 20 years within our disposal data are SUVs, and that jumps up to 65% when we look at vehicles just up to 3 years old. And that sector recorded an average movement of minus 0.9 or £180 down.
And I mean, obviously, we can't have you on talking about the market without bringing in the conversation around battery electric vehicles, and obviously they remain the key conversations across the sector at the minute, following obviously several months of, let's say, softening. I mean, how are they performing now over the course of July as we move into August? I mean, have you got sort of a view of what's been happening in that sector?
Yeah, of course. And yeah, you're right. It's the one thing that most people want to talk to us about consistently, and rightly so. And we are reporting now on the 9th consecutive month of reporting negative adjustments to BEVs. In fact, values have declined in the last 33 of the last 35 months. BEVs remain the fuel type under the most pressure, with values across all ages and all profiles reducing throughout July's cap live. Again, the benchmark at 3 years 60, and it's similar at 3 years 30 as well for EVs. The average movement was 1.8% down, which equates to just over £355. Of all the BEVs, though, that we valued at the 3-year-old point, we did move values, we made no change to values to 23% of them, which was a similar amount to last month, while 67% experienced value reductions, which was a slight improvement on June's performance, or June into July, as that was at 75%. Meanwhile, only 6% of those BEVs saw values increase. 6% of BEVs saw values increase, which again was up from last month, which was 3%, but still a small portion of vehicles.
And with that in mind, then, I mean, obviously the movement at that 3 year 60, but obviously you've identified there a proportion that went up and others that stayed level. What are the standout movement models in terms of, either up or down movements that sort of, equated to that overall average movement?
Yeah, no problem. So at the 3-year-old point, notable downward movers included models like the Volvo EX90, down 5%. Tesla Model Y, we continued to see volumes increase for that coming back into the market. That was down 4%, and the Citroen C4 was down 3.9%. But of those models that stayed level, and there's some mainstream models within that, which is encouraging, we have Vauxhall Mocha, Kia Soul, and Peugeot 208. But more positively, let's look at the models that increased in value. They include the Jaguar I-Pace, that just looks fantastic value for money in the used market now. That went up 1%. The Peugeot Traveller, 2%. And the Mini Cooper, which I think for the second or third month running now, we've seen increases. This was up 4%. Again, it's another model that just continues to look really good value for money. Retail and trade, you're looking sort of below £11,000 despite these increases. I think people are starting to get switched on to the fact that they're good value for money for a lot of people in the market.
Yeah, and it's interesting. I mean, it is an example I have conversations about, because it was under quite a bit of pressure for a period of time. Then it gets to, as you point out there, it gets to a point that it offers a good value proposition to the market. I mean, in general, would you say there's kind of, I mean, you've talked through some of that volume percentages that haven't seen any negative movement, although the sector did move overall. I was starting to see a decline in the slowing of the rate of decline in that battery electric vehicle market as values become, a more affordable proposition.
Yeah, I think it's probably jumping the gun to say 100% yes, we're seeing that. I think you're starting to see some encouraging trends the last 2 months. So June ended up being a record month, and I think we probably say this every month now in terms of the used to sold transactional data that we've received. We currently break over sort of 10,000 records now on a monthly basis. So we're seeing more returns into the market, and actually values haven't come down in the last 2 months as when we compare it to the 2 previous months to that, when we saw movements down of nearly 3%. So there's more volume coming back, but values are still edging back, but not at the rate that we've previously seen. But something that we are potentially, when we look at historic data for BEVs, where there could be some encouraging signs starting to appear. So when we compare this year's cumulative movement or performance so far for BEVs to historical patterns, currently BEV movements are tracking nearly 2.5% better than the same period last year, suggesting some stabilisation in the rate of decline. But the data reveals more, potentially, something that we're kind of scratching our heads with a little bit, but more seasonal patterns, where summer months typically represent the weakest performance in BEV values, with the second half of the year historically showing a more stable conditions. So this pattern was particularly evident last year, when values stabilised significantly after July, and then remained relatively flat through to the end of the year. I think it was October and November. BEVs were the only fuel types to see increases in values. So we're watching with a close eye if this year's going to follow some of those seasonal trends, and if this will continue. And we kind of scratch our heads, go, well, you'd have thought BEVs would have better range in the summer. More people would want them. In the winter, they get impacted more. So we're not sure why this is starting to appear. It's really early signs, but it's something to keep a very close eye on. So maybe we're starting to see a slowdown in the decline.
It's going to be interesting. That's a bit of evidence that probably nobody's thinking of that. If there is some seasonality around EVs and why that is the case.
And it may just be, it may not be anything, but the last 2 years certainly seen that pattern. So if I'm on in October, November, and EV values continue to drop, I probably won't reference I mentioned it 2 months ago. But
Curtis is busy writing it down in the background.
It's too late now, Chris.
Chris, you said. But it's certainly, we all look at historical data, historical trends, and that kind of helps us inform our patterns for the future, and our view of the future. And if, say, the last 2 years, well, the last 3 years really is anything to go by. August, September and October have been relatively stable months for BEVs. And I think if we have a couple of stable months, it'd be welcomed by many people. But let's not forget that since 2022, a 3-year-old BEV has roughly dropped 70% in value of that time. So we're not saying that it's recovering, but any form of stabilisation would be welcomed by many people.
Yeah, definitely. And we can't have you on, and we shouldn't really talk about fuel types without talking about what you're seeing in hybrids and plug-in hybrids, petrol and diesel, because everyone's talking about obviously shortage of diesel. Is that starting to see a bit of positivity? What's happening around hybrids with the latest consultation change around the hybrid market for the ZEV mandate? What are you starting to see in those other fuel types?
Yeah, so again, at the 3-year-old point, diesel recorded the best performance from July into August, with a negligible movement down of just 0.1% or £10 followed closely by petrol at 0.3% or £60. So that traditional ICE vehicle still in high demand, but again, more of a shortage of those vehicles between the 3 to 5 year old point in the market. So that's where we're seeing some strength in that. PHEVs showed slightly better performance than in the previous months, with just a 0.6% down movement or £170, while hybrid electrics, so pure hybrids, dropped into the bottom two for the first time this year, of a movement down of 1% or £170.
Back after the break with more from Chris Plumb shortly.
You're listening to All the Chatter That Matters, a special weekday episode of Motor Trade Radio, powered by Motors, the driving force behind multi-site advertising.
Chris, each month you analyse retail activity by days to sell. How did they perform in July compared to June?
Yeah, even though we have 1 or 2 days left to go, it's looking like there's not been much improvement in terms of July to August. Sorry, June to July, where the average days to sell, a rough average or an average across everything, is about 40 days. But as we know, the devil is always in the detail. When you look at fuel types, so HEVs remain the fastest selling at 37 days, followed by petrol at 39, BEVs at 40 days, BEVs are at 41 days, and diesel being the slowest. So kind of going against a little bit what we're seeing in that trade movements at 43 days. But let's not forget, for anywhere between 30 to 40 days average selling day or days to sell is kind of in line with the norms. Retail activity throughout July remained consistent, like I said, with previous months. Probably reinforcing a steady, albeit highly seasonal theme observed across most of the retail network or our retail partners that we talk to. Car supermarkets continue to outperform, showing slightly better or higher levels of activity compared to franchise dealers and independents. However, overall activity or industry sentiment remains particularly subdued, particularly when compared to the more buoyant conditions that we saw in the first quarter of this year. But it does feel like the retail markets return to that more highly seasonal sort of patterns.
Yeah, and you also polled the views of the auction houses. What were they telling you about stock levels and trade demand for the month?
Yeah, it's the auction server that we send out is really interesting in terms of the feedback that we get and kind of how aligned it is, how everyone seems to be aligned. 42% of respondents reported that stock levels are about the same than in the previous month, so June, albeit having reduced quite greatly from what we saw from May into June, while double the number of participants indicated that stock had increased. But again, it's a small proportion of people who reported that. But overall demand remains really strong in auctions, with 80% of respondents reporting that it was either the same or increased from last month, with only 17% saying or reporting that it decreased. And again, I think that kind of helps explain the relatively modest value movements. Yeah. If auctions houses are reporting that demand has either been the same or stronger than last year. I think conversion rates, though, remain particularly healthy for this time of year and are still averaging between sort of 75 to 80%. And the strong conversion rates or performance combined with the stable market or demand patterns suggest what buyer appetite may be modest because of retail being subdued. Those who are attending auctions remain committed to purchasing at the moment.
And really, I mean, thinking about the coming month of August, I mean, what's CAP HPI's view on how prices will perform as we enter August? I mean, let's say more traditional, quieter time for the sector in terms of that holiday period, the summer holidays, and pre-new plate month. What's your view as to where we expect to finish August now?
Yeah, so like previously mentioned, we always look back in terms of what's happened in the past. That kind of gives us an indication, hopefully, to what's going to happen in the future. And the historical analysis of CAP Live data transitions into September's monthly valuations. Again, when we take out those two affected COVID years, the average market movement is down 0.7%. And we don't think that this year is going to be any different. If we look at those the patterns which we've observed so far this year in the monthly movements, it even wouldn't surprise me if the movement that we make is actually more positive than that 0.7%. But as like you said, August traditionally, we kind of see a bit more of a subdued consumer activity as retail buyers seem to prioritise summer holidays over vehicle purchases. But where that demand might drop off in retail, certainly those limited supply coming into the used market, especially between those ages of 3 to 5 year old, which is that real sort of key metric for retailers. You're not going to see a particularly an increase. In fact, many of the auctions and wholesalers and remarketers we're speaking to predict the volumes to actually decrease through August. So any dip in consumer demand will be matched again by that dip in supply, which will mean that the market will remain fairly nicely balanced as we go into September.
And Chris, you're actually back next month, aren't you? So we can we can challenge you
I am,
on
yes,
0.7%. We thought it'd be a good idea, as we've got you on the pod today, to ask you about a couple of other sort of kind of related areas. And one of the things that particularly interests me is the emergence of these new brands and how you as a business actually go about setting residual values for this plethora of new brands, mostly from China. Can you shed any light on what the process is there?
Yeah, so when we're setting forecast valuations, and that comes from Dylan Settersfield and his team who sort of produce the forecast values. So I've had to take a bit of a steer in terms of how sort of the process on that, because we're looking at the here and now in the current market. And I think it was quite difficult when the first sort of new entrants came into the UK, or the first wave of new entrants came into the UK, because there wasn't many vehicle or new brands that you can compare it to. So initially, something like when we set the forecast values for the BYD Atto 3, we actually set them against or benchmark them against products like the Toyota BZ4Z, which is easy for me to say, because actually some of the Korean products or the Korean brands, rather than doing it to the Korean brands, which you probably thought would be a natural fit, some of their equivalents were too high versus the Atto 3. So we had to look at other models that fit within that, and the Toyota, being a traditional OEM, kind of fit quite nicely. But we often include legacy mainstream brands in our comparisons. Initially as a ceiling doesn't mean that the new entrants can't break those ceilings, but we positioned them, we use that along with the current brands in the market to sort of get an understanding of where that vehicle sits. But the one thing we kind of reinforce with CAP HBI, the conversations with the new brands, is to get an understanding with them, have discussions about their expected volumes, routes to market, marketing spend, and effectiveness around aftermarket provision. The amount of new brands we're having discussions on warehouses, which is something we'd never discuss with mainly a traditional OEM in terms of those fast turn parts. Where are they going to be? Where's the service network? The things that really matter in the ownership of a vehicle, either be it sort of after sales perspective or even buying a new vehicle. We're taking all those things into consideration when setting those values for both new and used. But like anything, as more data comes in, as there's more brands, it's easier to benchmark against each other. But in those initial days, it was quite difficult, but it's an easier process now, because you can take in the new brands that are currently in the market and then use some of the more traditional OEMs, so to speak, and place them in the basket of vehicles.
That really is fascinating, Chris, because I assumed that you would be setting them against the Korean brands rather than the Japanese or European brands. But from what you described, you really look at it in the whole, don't you? You're looking at a number of different brands, regardless of where they're from.
Yeah, and I think that reflects consumer behaviour at the moment as well. I think, all the insight that comes out, consumers aren't just looking at the brand loyalty is kind of changing a little bit with all the new entrants in the market. And they might be speccing up a new vehicle from a traditional, maybe a premium brand, and then going into one that, or looking at a new entrant and seeing what that compares it to. So we're kind of, I guess, going through a similar type of process when we're setting those forecast values and use values. But yeah, you kind of have to look, because there's so much choice out there in the market. It certainly keeps the forecast team very, very busy.
Yeah, I can imagine.
Yeah. Amongst other things, and we'll get onto that now, Chris. So, and the final question for today, and the timing couldn't have been better for you to come on the podcast rather than Jeremy. And we, obviously we've had the electric car grant we've talked about in the last couple of Saturday headline podcasts on the show. But the electric car grant, still kind of early days yet of the detail behind. Well, we know the detail, we just don't know who can get the car. But will it start? The big question is the risk of potentially starting to have an impact on residual values once the models available that can get the credit or the incentive become available, or the fact that there are OEMs already starting to react with their own equivalent incentives for their products. What's your view on this in terms of the RVs side of things?
It's like you say, it's still really early days. I think everybody's waiting for a little bit more detail to come out. Is it 11th of August when we're expecting the models to be confirmed that will qualify for either banding 1 or 2? We've had lots of conversations with OEMs in terms of sort of asking us about different strategies, and if they do one thing, how will it impact the residual values? I think from a very simplistic view is that because used pricing on many BEVs, especially at 3-year-old, are so far away from the list price, any grant won't particularly impact the used value. It may be a slight issue when you come into sort of sub 24 months old, but that issue remains in the market today. It'd be interesting. I think we're waiting for clarification to see how manufacturers and OEMs use the grant, the ones who qualify for it. Obviously, we've seen those Chinese manufacturers introduce their own grant by effectively either discounting the vehicles or reducing the list price. Again, when we've looked at those models individually, they're so far away from the used value at the moment, it doesn't have that much of an impact. We're aware that the new car discounts currently in the market, some of them are quite high, 10 to 20%. So will those discounts be rolled back and be replaced by the grant? If the discounts are still there at those levels, and then the grant is available, then we might have to review how many vehicles are actually quite close to that list price. But I still don't think that there's going to be that many. So still very early days. I think the one thing that, putting my used hat on, and the news of the grant, even though it's great news for new car adoption, I think the one thing that we're disappointed with is that there's been no support for the used vehicle values, because that's what I look at day in, day out. And we know from the likes of the BVRA, the VRA and the IMDA that they'd like to see more support in that, because in my simplistic view of the market, is one way to stabilise values is increase used car demand, consumer demand, and the way you do that is that means that there'll be more consumers coming onto dealer forecourts asking for vehicles, more competition in the wholesale market, and then you'll see that trickle up. So while it's really positive from consumer, and actually I don't think there's been, I probably said this every month for the last 3 or 4 years, but I don't think there's been a better time for a consumer to buy either a new or used EV. But it's just that focus on the used EV. But hopefully, if not everyone will still be able to afford that new vehicle, and if there's more inquiries coming into dealers inquiring about the vehicle because of the grant, that it might be an opportunity then to put them into the used vehicle if the new vehicle with the grant still doesn't match their monthly payments. So let's use it as an opportunity not to lose those customers as well.
Yeah, no, I couldn't agree more. I think, like I say, I think generally the sector is disappointed that there wasn't something a little bit more focused as used cars. It's quite a complex grant or incentive that they've put in place, and obviously, but I think you agree that it's still, and this will be on a podcast next week that we've recorded. In the view of the sector from some of the dealers is it's new money. It's money coming into the sector, all right. It's not necessarily through the right channel. It might not, necessarily trigger the correct activity in terms of that use, but it's still money from the government that's coming into it. It's already triggered, increased incentives from the OEMs to compete against the potential of these incentives. So, as you said right at the start there's never been a better time to buy a new electric vehicle in the market. And, however you look at it, it's grabbed a headline, it's triggered that interest. And if it gets more people talking about electric vehicles and experiencing them, then you know what, it's a good result. But how much activity it'll do and what the results will be, I think is yet to be seen, isn't it?
Yeah, I agree. And hopefully when we convene next month, there'll be more detail. And if we've had to make any changes, we'll obviously run through them on the call.
No, that's fantastic. And I mean, as always, it's brilliant to have you on. I know it's the day of the editorial and you're busy anyway. And I mean, just finally, huge thank you for coming on. And obviously, but people can get hold of the editorial either through the cap-hpi.com website and the full editorial for cars, which is what Chris has been talking through there, or the future gold book from Dylan, or the commercial vehicle and bike editorials as well are available there, or just contact Chris through, or Jeremy through the channels, social media channels through LinkedIn. And just finally, Chris, you've had a recent webinar, and I think you've got another one coming up.
Yeah, so the most recent one was about 2 weeks ago, and if anyone who missed that would like a recording on demand or a copy of the deck that we went through, and there was a section from Matt Freeman, who's one of our consultants within Cap Consult, who gave an overview of the new entrants into the market and what the Chinese market looks like. Please get in contact with me. I can set you up with a recording and the deck from that. But also, we're still penciling in the date for the next webinar, but it's likely to be early September, the first week in September. Anyone who would like to be included in the mailing list for that, either send me a direct email or find me on LinkedIn, because I'll be posting the invite for that. But yeah, again, that would be, as always, it'd be interesting to sort of track what's happened in the market through that time. But I'm sure we'll have more of a focus on EVs in that webinar.
Yeah, so do look out for that, and we'll probably have more details when we speak next month on that, yes. Chris. But until then, many thanks for coming on the pod. Really enjoyed our conversation today.
Yeah, thank you. Thanks for inviting me again. And yeah, it's great to catch up with you.
But that's all for this special weekday Motor Trade Radio podcast. Thanks for listening. We're back with the big car retailing headlines this weekend. Until then, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising. Philip and Curtis will be back with the week's big motor retailing headlines on Saturday. Live, on demand, wherever you are, on your podcast feed.